It's hard to breathe, but that's alright. Hush.
Hey, what's going on, guys? So yeah, hopefully you just watched the Wyckoff distribution example, and this one we're going to be going over a Wyckoff accumulation example. Now this one is on a separate pair, euro dollar, because all I could have done is literally just flipped around the gold trade and classed that as my accumulation. But I didn't want to do that. I want to show you a different example, much more cleaner, and yeah, just so you understand the different examples, right? But it's going to look different every time. So if we just look at the accumulation schematic, you can see here that again, it's very simple. It's literally exact opposite to the distribution. You got scam 1, scam 2, so we'll just call it type 1, type 2. And all the differences, as you can see, I probably don't have to tell you, but it's just a spring in phase C. You usually don't see that in scam 2. So, you know, if you were to take a trade based off schematic number 2, like we said in distribution, look for the 2 lows. But in accumulation scam 1, the most, preferred ones for me to see personally is 1 touch, 2 touch, 3 touch. So it's very simple. Like you see the, few touch on the distribution side, we're looking for the 3 touch on the accumulation side as well. So again, very simple. Accumulation, liquidity sweep to the downside, mark up, right? But there needs to be a previous, as you probably guessed, mark down. Okay, so in order for the price to come down, accumulate, come back up, accumulate, come back down. Okay, so as you can see, this one's very choppy. But on the high time frame, the daily, we were overall moving to the upside. As you can probably see there, we got 1 touch, 2 touch, and a 3rd touch. And on the smaller time frame, what we see as well, we start to see that shift, change of character. Okay, so we've broken to the upside. Previously broken to the upside. We're starting to, see the previous range here as well. So again, this tells us that this could be, an accumulation phase. But if we go down and look at this entry, in which where we entered, that was a nice accumulation phase. Okay, and I'll show you that now. So if you go down to the one, what can we see here? We've seen 1 touch. Alright, if we just zoom in, 1 touch, 2 touch, 3 touch. Right. So what price has done? Okay, liquidity sweep. And then price came back into this region, right, and started to see these up moves. Break of structure, came back down. So if you just entered, you could have, if we just look back here, right, see here, left an order lock behind anyway. So you could just measure that as a whole demand zone, right, and that would have been a nice entry just based off that alone. Because obviously, if you look at it in terms of Wyckoff, I don't know if we ever get there. As you can see, price created equal lows, liquidity sweep. So we see that as an accumulation, just as an extra confluence. And then price starts to break back to the upside, broken above structure. So again, you could have took a trade around here or here. Price continued to break up and break up and break up until we finally break above there. Again, we have this range created supply zone or demand zone. Because obviously the neutral candle, we don't really, want to include them candles, or want to try and focus on these, sort of bigger bodies, right? So that's the last candle, the last down move before the up move. So again, that would have been a nice entry there. Your stops just below the wick, keeping it, real. And again, targeting the higher time frame highs, in which we did up there. And we could have continued to hold this and hold this and hold this until, further on. But we were just targeting the highs. We were happy with that. We were monitoring the trade, or managing the trade. Price came back up, broken structure, so our stops would have been at break even. Continued to break structure and break structure. And we broke this one. Could have moved it below these lows. We continued to do so. So when price broke in here, we could have moved our stops below here because it broken above into the new range. And we entered the new range, move our stops. So we could have just managed our trailed our stop loss very aggressively, and that was a nice 22.5%. And all we noticed was high time frame point of interest. So you could have took a trade off this one if you wanted to, but for the extra confirmation, we want to see the break of structure and the mitigation. Right? Came back down. Probably if we had a risk entry on here, we probably would have been tapped into with the spreads, but it came back down again and tapped us in very nicely. So even if you did enter here, again, as being the calm composite man as we've spoken about, you wouldn't have, really moved your stops to break even just yet because we didn't leave this range. We're still within, again, this range. So until we leave that range, this would then be our new low. This would be our new high, but then we obviously started to break. So yeah, so just pretty much just manage your trade accordingly, trail your stops, and yeah, that was pretty much it for the Wyckoff accumulation. It's very simple. So if you haven't really understood this, make sure you watch the Wyckoff distribution. And all we look for Again, there's a previous markdown, then we should see something like this: a low, 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 and then up, because obviously we've got low, 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 or even this low, and then yeah, mitigation, boom, right? And that's very simple, and that's exactly what we've seen here. And again, that was a brilliant trade, and if you want to play aggressively with our stops, ignoring the wick, that would have been a 36, but again, being in the calm composite man we want to have our stops below the wick, right? And you could have even entered here after this minor structure break. This is a valid demand zone because of broken minor structure, but again, we wanted to see that bigger structure break, right? But again, if you were more of aggressive composite man, you could have took a trade there, and that would have been a nice trade, and you could have scaled in here, you could have managed your stops aggressively. And that's just the the differences between the calm composite man and the aggressive composite man. So it's up to you how you want to be. You probably already guessed that being a calm, patient guy in trading is going to be the one that pays you well. If you realize that as well, then yeah, why not be the calm composite man? And it is literally like, when we say composite man, the composite man was just someone who he thought was a fictional character that wasn't existing. So it's pretty much almost treating it like a game. So we know it's a game, the manipulation in the game, and we're being that, we're imagining ourselves in the game being that calm, collective guy. That's just the way he saw it. And when you start to see it that way, it is a true eye opener, because now I just see it as one big game. Putting the puzzles and pieces together, and just be in control. And we know, in order to be successful in this, again, like I said, if you want to be aggressive, you can, and you can get in some nice trades. But if you want to be long term, you want to have a much stress-free career in trading, be the calm composite man and be that guy from day one, and just believe the theory less is more, because it is. But also more can be more as well. But I do 100% believe in less is more, because it is 100% true. So yeah, that was a nice little sort of trade recap on your dollar, I suppose you could say, with the accumulation phase. Yeah, that's pretty much it, guys. So thank you for watching. I don't think I missed anything. I hope I haven't missed anything. But if I have, and you have any questions about the accumulation or distribution, ask me. But remember, just look for the equal lows, or because that could be one touch, two touch, and a third touch. Because again, 1, 2, 3, boom, and test and boom. So again, when price does something like this, liquidity sweeps below, goes back up, test it, and then breaks structure, that's going to be the most high probability setups, right? But just understand your ranges, understand the mitigations, and be calm, right? That's my number one advice, is just to be calm, because the more calm you are, you are going to get nice rewards, right? But again, by all means, I can't control what you want to do. If you want to be aggressive, you want to be on a 1 minute time frame constantly, it's up to you. But we notice this on the higher time frame is literally, even on the 1 hour time frame, there's an order block down here, and yeah, because this is a big range, because there's a previous markdown range, so we could see this is an accumulation. And yeah, that could be accumulation, because you got the 1, 2, 3 test, boom, right? And that could be an accumulation phase. It is sort of considered it when you look at this. Obviously it's just equal lows, liquidity sweep, and then the test, and then the boom, right? And then you could have scaled in here, here, and there's plenty of scales in even here. Yeah, but that was a 22.5%. All we did was just target equal highs, and if you even wanted to just play it more, safer, you could have targeted there, which would have still been a nice 8% trade within a few minutes. Okay, so yeah, guys, I hope you enjoyed this one. It's very simple. Just notice the 3 points, right? So if you don't want to trade scam 2, that's fine. This is again, I don't trade it, I just look for the 3 points personally, but sometimes I do like to mark them up and just send it to you guys as well. So when I do mark it up and send it to you guys, and then you usually might sometimes see scam 2 being involved, but scam 3 is more better, because it's like 1, 2, 3, boom, test, whatever, right? So yeah, that's pretty much been a Wyckoff accumulation. Again, any questions or concerns, message me and I'll help you out.